first topic kind of requires you to pay attention a little bit. Basically, the taxpayer that it affects is a person who plans to sell a principal residence. Okay, and then they expect to claim the $250,000 if you're single, the $500,000 if you're married. This is the taxpayer it affects, but it also affects the tax. In addition, it affects the taxpayer who has rented out their principal residence after 12/31/08. All right. Now, what it says, what this provision says, is you cannot exclude the gain from the sale of a principal residence that can be allocated to periods that it was not used as your principal residence. All right, so we're going to go through a couple examples. But basically what it's saying is that after 12/31/08, you've got to be careful. You just can't say to the taxpayer or to your client, oh yes, if you've lived in a principal residence 2 out of the past 5 years, you get to take the exclusion. You can't say that. And frankly, you shouldn't be saying that at all. But you know, people will think that they can get that exclusion. The key to this is if they rented out their principal residence after December 31st/08, you have to say to them, gee, I think you should go talk to your tax preparer. All right, now we're going to go through the explanation. So this refers to periods after 12/31/08. And non-qualified use means property used as a vacation property or a rental property, not as a principal residence. Let's take an example. Now, as we go through here, what I try to do is color code things. The things that are in green are good years. The things that are in red are bad years. So let's assume you have a married couple who purchases an investment property for $800,000. Also, let's assume that they rent out the investment property from during the years of 09, 10, 11, and 12. So they rent it out, let's say, for 3 years. They convert the investment property to a principal residence. Conversion from a rental property to a principal residence is not a taxable event. It doesn't show up in the taxpayer's tax return. And let's say they live in the property for 2 years as a principal residence. Those are good years. Now, let's say they sell it for $1.2 million in the 5th year. Under the old rules, that $400,000 gain would have been excludable because what you do is you look back 2 out of the past 5 years, they lived in it as a principal residence. Under the old rules, that would have worked. But under the new law, the 2 years that they rented it out and didn't live in it, they don't get the exclusion. So 2/5 of that exclusion, or about $160,000, is not eligible for the exclusion. So you as a realtor, if you had said to the client, oh yes, you lived in the property 2 out of the past 5 years, that would have been wrong because they don't get the full exclusion because of those past 5 years, 3 of them were used as rental property. Does everybody kind of see how that works? Okay. So 3/5 of the gain, or $240,000, is considered attributable to the years that it wasn't used as a principal residence. All right, so you got to be careful. Basically, the best tax advice you can give to a client is go see their tax preparer, because what you learn today may change tomorrow. You see, and this is one of the rules that's kind of a gotcha to realtors because they would think that, gee, you lived in a house 2 out of the past 5 years, you get the $500,000 exclusion. But now, if they rented it out any periods of time after 1/1/09, you don't get the full exclusion. And it's kind of a complicated way of computing it too. Let's look at an example. Let's assume that the person lived in a principal residence for 10 years. And notice this is all before 2009. So they lived in it 10 years. They rented it out 3 years after 09. And then what happens is they get to only exclude 10/13ths. The denominator, the number that goes underneath, is the, actually, I gave this speech to the California State Society of CPAs, and I was in both San Francisco and LA, and it was a little more, obviously a little more technical, but I told them that, once you get into fractions, accountants rule the world, because nobody paid attention to fractions when they were 3 years old, when they were in the 3rd grade. And I told the joke about the guy who goes into the pizzeria and he orders a pizza, and he says, the guy behind the counter says, do do you want me to cut the pizza in 6 or 8 pieces? The guy thinks for a second, he says, well, why don't you cut it in 6? Because I don't think I can eat 8 pieces. See, you guys got that. Okay? But you understand fractions, so you'll get this. Okay? So the denominator is the total number of years you've owned it. The numerator is the number of years you've used it as a principal residence. Excluded from that numerator, the number that goes on top, is the 3 years that it was a rental property. Can you see how that works? So it's a little complicated to how you go about computing it. The other 3/13 is a portion that goes to the point that it was not used as a principal residence. Let's use another example. Let's assume that from 99 through 04, they used it as rental property for 5 years. And now this is pre-09. And then they use it as a personal residence for 5 years. Again, they use it for 3 years after 09. Again, the denominator is still the 13. The numerator is still 10. Even though they used it as a rental property prior to 09, the years before 09 don't count. You see how it gets kind of complicated? You see why you really don't want to get in a situation of advising a client? So the 3 non-qualified years are counted only after December 31st, 08. All right. Let's go for another example. Let's assume they rented the property for 5 years. They used it as a personal residence for 5 years. They used it for rental property for 1 year after 09. Again, and it was also vacant. That's right. They had to move out, move back, whatever. It was vacant for 2 years. Well, the vacant property years don't count. So now the numerator, total period of time they own the property, 13 years. The denominator, 12, includes the vacant years because they don't count. So again, you get to exclude 12/13 of 400,000, and you don't get to exclude 1/13. So again, it gets kind of complicated. That's what I'm suggesting. Another provision, they had 5 years as rental property, 5 years as personal residence, 1 year as a personal residence after 09. You look at that, and also they had 4 years of rental property from 10 to 14. Now you got to think this through. Remember, the rule is you have to look back 2 out of the past 5 years. In this circumstance, they get 0, because if you look back 2 out of the past 5 years, they've rented it out 4 of those years. So they don't qualify just basically on the basic law. The thing that I'm trying to impress upon you is don't make those calculations. It's not what you should be doing. If you have a situation where you have a client that has rented out their property after 09, you simply say to them, you know, you may not be entitled to the exclusion, and I suggest you speak to your accountant or tax preparer, because it's not as simple as it was in the past. So, any questions about that? Yes, sir.
That income, can that one be 1031 exchange?
Good question. I like that. Near and dear to my heart, I own a company called Downstream Exchange Company. The gentleman says, well, wait a minute. If you can't take the exclusion and you've rented it out for the last 4 years, can you do a tax-deferred exchange? The answer is yes, because you've converted the character of the property to an investment property. You've held it for an investment period of time. Thank you very much. No, I didn't plant that, but thank you again. Any other questions?
Yes, sir.
Yes, sir.
How are vacation homes treated?
Vacation homes are very, very difficult to deal with. It's a whole different subject. Basically, it depends on how they treated it on their tax return. If they treated the vacation home as a rental property, showed it on Schedule E of their tax return, and depreciated it, and did not use it more than 14 days, isn't there a $5 fine for that?
Yeah. $15.
Let me go back and start again. Vacation homes are treated differently. If they put it on their Schedule E, rental property, did not use it more than 14 days out of the year, and depreciated it, that's considered a rental property. If they use the property more than 14 days out of the year, deducted the interest and property taxes on Schedule A, it's considered vacation property. If it is vacation property, you don't get the exclusion, you're not able to exchange it. If it is on Schedule E, you have the ability to exchange it, you still don't get the exclusion because it's not your principal residence. So there's lots of what ifs, and you have to kind of think your way through those kinds of things. Any other questions? Okay, let's move on to the topic that I understand is the highlight of the discussion. why all realtors, or all real estate professionals, are more desirable as spouses. Okay? First of all, there are some passive loss rules, and basically what they say is that all of your income or losses from real estate are considered passive. And back in 1986, they changed the law that said you cannot deduct your passive losses against any other kind of income. So they kind of segregated off these passive losses. And basically what they said was you can only deduct these passive losses against passive income. Or if your adjusted gross income is less than $100,000 and you actively participate in the management of your real estate property, you can deduct up to $25,000 of your expenses. But if your adjusted gross income exceeds $150,000, then you cannot deduct the $25,000. So if you have a client that has a piece of real estate and it produces a loss, that passive loss is eligible to be deducted up to $25,000 if the client's adjusted gross income is less than $100,000. If their adjusted gross income exceeds $150,000, they get no deductions. All right, so everybody kind of see how that kind of works? Those are the basic rules. But there's an exception, and it deals with real estate professionals. And basically what it says is that passive losses are not subject to limitation if the taxpayer meets certain eligibility requirements. Well, there are basically two requirements. The first requirement is that more than 50% of the individual's personal services during the tax year are performed in real estate property trades and or businesses in which you materially participate. Do you as realtors fit into that first rule?
Yes.
Second rule, the individual performs more than 750 hours of services in those businesses. Do you fit into that?
Yeah.
So that means that you all are real estate professionals and are subject to this special rule. Well, what is the special rule? It says that if one of the spouses in the joint return meets those two requirements, they can deduct all of their passive losses. Now, let's look at an example. Let's assume that Sue, a full-time realtor, has adjusted gross income in excess of $150,000 and has an apartment house which generates $15,000 in passive losses per year. Because Sue is a real estate professional, the normal rules don't apply to her. She gets to deduct all of her passive losses. That's a good deal, don't you think?
Yeah.
It's excellent because it segregates you or puts you into a special category that other taxpayers can't get into. Let's change the example a little bit. Let's assume Sue, a real estate professional who has a passive loss of $15,000, marries John, who's not a realtor. And he has an apartment house which generates $30,000 in passive losses. And their combined adjusted gross income exceeds $150,000. Well, John, unmarried, with an adjusted gross income exceeding $150,000, doesn't get his passive losses of $30,000. But because he's married to Sue, who's a real estate professional or realtor, she gets to deduct her $15,000, and because John is married to Sue, he gets to deduct his $30,000.
Marriage has privileges.
I submit to you, is not Sue more desirable as a spouse? Because John, a non-real realtor, gets to take all of his passive losses if he marries Sue. Now, it's interesting to me, I gave this speech a long time ago, and I got a call, I know what it is. I teach for the Graduate Realtor Institute, and I wrote a little thing for them, and they send it out every February for Valentine's Day. It's why realtors are more desirable as spouses. I got a call from a lady up in Monterey, and she calls me and says, I got this. And she asked me these very direct questions. She says, look, I'm a realtor. I think I fit into this classification. Is that correct? And I said, yes, you do. I have a dentist as a boyfriend, and he has passive losses. If he marries me, does he get all of his passive losses? And I answered yes. Now, I can imagine that conversation on the couch. You know, gee, baby, if you marry me, you get all your passive losses. Right? 6 months later, I get a wedding invitation. Now, this, you know, I must answer dozens of phone calls per day. I couldn't remember who this person was. I'm getting this wedding invitation. I'm thinking, well, who is this person? So, I call, and she reminds me of who she is. Now, if your marriage is based on that simple thing, yes. But I can see people updating their information on
Twitter?
no, what's that thing called?
Wikipedia.
No, Harmony.com. You see it? If you marry me, you get all your passive losses. There was an interesting court case that just recently was decided in 2009. And basically, the IRS doesn't like this. They just go really hard at this, trying to disprove if you're a real estate professional or not. And what they tried to do in this one court case, they tried to say that, look, unless you are a broker, you're not eligible for this classification, even though you spend more than 750 hours and half your activity is in real estate related businesses. Only if you were a broker. Fortunately, tax court says no. There's really no difference between a real estate. There's no difference between a salesperson and a broker. All right, so that's was decided in your favor. Any questions about how you become more desirable as a spouse?
Is the